back to The Lens, a conversation series hosted by the Bear Traps Report. This week, we're going to talk about what happened in the markets, what's happening on the Hill, and we have a report just for that. We have the Washington pressure points. We just started maybe 3 or 4 months ago, and if you're interested in receiving that, you can let us know at info@thebeartrapsreport.com. This week, we have an outstanding guest, Mark Cooper, CFA. He's the co founder and CIO of Mac Alpha Capital. He has over 3 decades of global investing experience across equities, fixed income, and commodities. He's a Columbia Business School professor for over 20 years, and he co authored the book Value Investing from Graham to Buffett and Beyond. So, Larry, Mark, go ahead. I want to hear what you guys have to say.
Thanks, Valentina. Great job. And special thanks to the whole team in New York this week. Outstanding performance. And I'm really proud of the team last year. We almost doubled the S&P performance at the Bear Traps Report with a huge allocation, an enormous allocation in hard assets across copper, silver, gold, and platinum and palladium. That currency debasement strategy of 2025 really paid off. Thank you so much to the entire team. And, Mark Cooper, great to see you, my friend. We host ideas. Good to see you, my friend. We host ideas dinners around the country and around the world last year, Zurich, Geneva, London, LA. But Mark was one of our best guests at the ideas dinners and probably one of the most well received from the clients. And I find it interesting that when you do the ideas dinners at the end of the year, you can kind of see 2 to 3 or 4 people that you really respect that are talking about the same trend shift. And that's why I wanted to bring Mark in today. And Mark, your background, your years with Leon Cooperman, but then you're one of the few people I've ever met that's spent a lot of time on the academic side, helping students, but also in a risk seat, hedge fund taking seat. Very unusual career, and I'm really impressed, and it's really inspirational. But thanks for joining us.
Thanks, good to be here.
So Mark, one of the things that people were talking about is that when you have that international value outperform the S&P by almost double last year, it's the type of thing that's historically not a one-year event. But tell us what's on your mind today.
Sure. So I would agree with that, Larry. We tend to be very data driven. So a lot of people have opinions about a lot of things. We like to look at what the actual data show. And so we go back through history, and this is a chart that we created going back about 55 years, which compares international stocks to the S&P 500. And we have kind of looked at the data going back probably all the way back to the Depression, pre-World War II, and it probably looks the same, but we do question a little bit of the accuracy of the data, so we kind of stop it at 55 years.
So when you were at PIMCO, were you doing the data work? So you were years at PIMCO, First Eagle. When did you start really crunching the data and trying to come up with trend shift analysis?
I started looking at the data actually when I was an undergrad at MIT. I mean, I was taking all the master's levels courses in finance at MIT when I was an undergrad, but nothing was equity related. But I've always been kind of interested in the math and the science side of things, and look at the data and what's the data tell me. So I think I followed that my entire career. And, it's always been, how do you figure out how do you do the best for your investors? How do you get an edge? And,
right.
So I think about being efficient and analyzing data and look at the history to know, because I think we all as humans have kind of faulty memories about, we think we remember what happened 5 years ago or 10 years ago, but do you really? When you look at the data keeps you honest. And the reality is, there have been swings back and forth from international stocks to U.S. stocks. If you go back to that first slide again, if you wouldn't mind taking one step back, that first slide. So going back over 55 years, if we go back to the international versus S&P 500, you see that international stocks are about as cheap as they've ever been over the last 55 years. And again, I would say this really goes back further than that. One thing is, I do believe as an academic is these time series do mean revert. They do trend in directions for a period of time, but then they do reverse and go back to the mean and often overshoot the mean. What you're witnessing now, and obviously most investors know this, is we've seen the domination really by the US, and US mega cap, Mag 7 stocks have dominated the market post the global financial crisis. with the Fed easing, quantitative easing, et cetera, central banks around the world, we've seen it kind of go in one direction. As hard as it is to see in this chart, we've actually seen a little bit of reversal. And this is through September.
Well, since
30th.
October, the Mag 7 is essentially down 1 or 2%, and hard assets are up 20 or something like that in value.
Yeah, so international stocks have outperformed, value stocks are outperforming. And I think your theme on hard assets for the last year, we agree with. There's also something to note is when we get to value stocks, we'll get there in a second, you see that value stocks do tend to correlate when hard assets do well. But we've seen an outperformance of international over the course of the last year. And you barely see it in this chart. It's barely a blip. We've got a long way to go. International stocks would have to triple versus the S&P from here to get back to this long-term 55-year average.
That's a mind-blowing stat.
And
3x from here to get back to the 30-year mean.
So if the S&P did something like zero return for the next 10 years, which is something we actually think is quite reasonable. If you look at long-term averages like the CAPE ratio, Robert Shiller at Yale is famous for producing other long-term valuation metrics going back to the Depression, you would say the S&P 500 is the most expensive or very close to the most expensive it's ever been in 100 years. And from these valuations, you should expect the S&P to return about zero total return over the next 10 years. And that would be bad enough if it weren't for the fact that we think, notwithstanding a zero total return over 10 years, is you probably get a 40 to 60% dip in the meantime. And that's what's much more painful for people. So we like to think about going where, I'm a big hockey fan, and I believe in the Wayne Gretzky quote, skate to where the puck is going, right? And
where it's been.
And Stan Druckenmiller says the same thing, right? If you don't invest for what the fundamentals are today or where they've been the last year, you and I had a discussion about this recently. It's not about what happened a year ago. It's what's going to happen, likely to be the case 6 months from now, a year from now, 2 years from now. And we think that, so value, this chart in value looks very similar to the chart we just showed you before. Value stocks are cheaper than they've ever been. They're cheaper than they were around the dot-com bubble of 2000. And we like to look at we like to look at a lot of data. We look at a lot of history. We think there's a lot of parallels in the markets today between today and the dot-com bubble era of the late 90s, early 2000s before it burst. And we think there's a lot of parallels to the early 70s with the commodities boom and inflation in the early 70s. And both of those, if we're correct, and we think we are, that ultimately you see value outperform growth. And again, it's been a great trade to be on the other side of this. So what's happened is people had a good idea. And what do humans do? We take it to excess, right? So a good idea, you like the tech stocks post the 2010, 2008, 2009 global financial crisis. My biggest position when I was at PIMCO in 2010 was Microsoft. It was one of our biggest positions, our fund, the entire time I was at PIMCO. So I'm not opposed to saying those are not great businesses. And I think they are great businesses. A lot of the Mag 7 are great businesses. I just think the valuations today are indicative of probably pretty poor future returns. And the problem is people, if they were kind of appropriately weighted 5 years or so ago, or 10 years ago, now they have a massive portfolio that's very concentrated in a few stocks. And we think that's extremely risky. So we think you want to go to where the puck is going to be.
And so now you're looking at small caps here?
Yeah, so this is small versus large. And this goes back, this is a little shorter chart, goes back just a little less than 50 years. And this is
how are you doing that? The Russell 2000?
This is Russell 2000 versus 1000.
Okay.
And again, we do this is a US based chart, not the other ones where, we had international. And it is because of a data question, right? There weren't a lot of small cap. The biggest small cap benchmark from a developed perspective only goes back to 2008. So you don't have a lot of data going back that far. So, and I've seen others do similar charts. A lot of other well-known institutions have put out similar types of charts. The one thing I would note here is you say, well, small caps aren't as cheap as they've ever been. And I would agree based on this chart, they're not. However, there is a couple major differences in these time series. And one is in the 98-2000 timeframe, there were about twice as many public companies in the US as there are today. However,
twice as many public companies in the 98-2000 timeframe. Wow.
So companies have been acquired and companies are waiting longer to go public, right? So now there's only about 4,000 public companies when there was closer to 8,000 25 years ago. The other thing is companies at extremely high valuation are actually more prevalent today. A greater percentage are at high valuations today than at the dot-com bubble. And not only is there a higher percentage today, they trade on average about 3 times more expensive than they did around 25 years ago. So there, and we think about this, if you think about stocks that say, if we say what's an extremely high valuation, think about stocks that are, call it 10 times EV to sales or more. So people are paying 10 times sales for the enterprise value, right?
Enterprise value to sales.
Sales, right? And there's about 300 companies that traded over 10 times EV to sales in March of 2000 at the peak of the dot-com bubble. 1 year later, the median return of those 300 stocks was down 79%, minus 79% in 1 year, the median return of those stocks. Today, there's a greater percentage of stocks that trade at those high valuations, but they don't trade at just 10 times sales. Many of them trade at well over 100 times enterprise value to sales, in which case the expectations, companies have to grow extremely rapidly within their circle of competence and generate great returns for you to break even over a 10 or 15-year period of time. It's unlikely that investors will get good returns from those. So,
what are you saying
US
here,
market,
Mark,
yeah.
with this chart?
Sorry. So this chart so people have seen quilt charts before, and we just rank top to bottom by year from 1996 through the end of 2025, which area of the market did the best. So you see, if you start in the far left, the bright green is developed international small caps in the bright green. And what you saw from 96 to 01 was a long period of underperformance for developed international small caps. And then you saw a tear from 02 to 05 where developed international small caps did well. If you look at the very bottom of the chart in the bigger red oval.
Mark, when I was on the trading floor at Lehman Brothers, 2003, 4, I was walking around to some of the senior managing directors at Lehman on the trading floor. Yeah. And I would say, what's your best idea? What do you own? And they were all long. All of them were long, international value. Nobody was long the United States.
Yeah. Absolutely. And what you've seen so from 18 to 24, 2018, 2024, with the big move towards Mag 7, you've seen more dominance of U.S. large caps, U.S. large cap growth stocks, and more underperformance of developed international small cap. It's lasted longer, which just goes back to the first chart I showed where international stocks have lagged and small cap stocks have lagged the most, right? Now, what's interesting about this doesn't incorporate value in it. What I would tell you is one of my mentors, one of our firm's advisors, one investor in our fund, is a well-known long-only investor, and his outperformance started in 2000 as a value investor. He killed it from 2000 to 2003 as a value investor, where the S&P or the NASDAQ was down about 75%. He was up about 75 on a long-only portfolio. And so developed international small caps was the best performer of this group from 2025, and we're seeing it continue this year.
So 2025, say that again?
So at the end of 2025, developed international small cap was the best performer on that quilt chart again.
Okay.
So despite what we're still seeing as a lot of speculation in the market, and we saw it really from kind of the April lows with tariff, we're still seeing developed markets, ex-US markets do better than the US, and developed international small cap and developed international small value doing well. And we're seeing, it's doing well for a couple of reasons. One is the valuations are low, the stocks are attractive. We're starting to see money flows come that way. There's a lot of interest in the space. There's a lot of RFPs for people to allocate money. We've seen it a lot in our own business where interest has picked up. And we expect this to continue for 5-10 years or longer. I think it will go on for a long period of time.
Excellent. And next slide. So we had a big move last year, and now we'll see if there's some follow through. So what I noticed, Mark, I wanted you to get your thoughts on this, but clients have been mentioning, so we run a Bloomberg chat with hedge funds, mutual funds, and pension funds. We love the Bloomberg terminal. It's like a private ideas dinner that we run every week. And we have some really famous investors in there. So what you can do is you can really get a conversation going about, let's get a conversation going about what's happening this week. And Mark, the move in staples this week versus Microsoft and NVIDIA are almost 14% of the S&P. Microsoft's down almost close to 19%. NVIDIA is down 12%. So the fact that the S&P is up means that there's a lot going on. I mean, think about that. the 14% of the S&P is down close to 18 and close to 12% off the recent highs, and the S&P's actually up on the year. And as you can see there, that move into the staples is impressive, and it's actually on a really impressive volume as well.
And you've seen it even down in cap. I mean, I'm sure that the XLP is probably dominated by the larger cap stocks. You've seen it in smaller and mid caps. I mean, I happened to notice today, like Clorox is up, like it's up almost 10% year to date. It's a great business, low valuation, been out of favor, but near 5-year lows, 3 weeks ago, and now the stock is up.
And now you got the mega cap growth versus value. The rate of change there, Mark, is, to me, that's the most impressive thing. As you can see on the far left there, that rate of change, a lot of people in the chat, hedge funds, mutual fund, CIO level people are talking about the rate of change from growth to value in 2021. And then how that compares to today, it's very similar. And that's what you've been talking about since that third, fourth quarter. Look at that rate of change into value.
Right. Yep.
Next one. And so that's the type of thing we want to look for, those trend shifts. We want to think, okay, is something big happening here?
Right.
And there's 33 trillion in the NASDAQ 100, right? 33 trillion, and up from 12 trillion 3 years ago. 3 years ago today is about 12.5 trillion, and now there's 33. So, 4 or 5 trillion comes out of that into these small asset classes. You can get 200% moves in the small asset class.
And that's part of the reason. So we think the companies are cheap. We think they're good. Like a lot of the business we own are very high quality franchise businesses that have great returns, but the capitalization is small. The small cap indices only in the small cap space developed are about 4 trillion, right? A lot of the markets, as people know around the world, UK, Canada, and some others, Japan's just a little bit bigger than NVIDIA, right? But the UK and Canada, you can buy the entire country for less than NVIDIA.
Right.
And so a little bit of money flows out of that and flows the other way. And we also know that a lot of private equity firms have put a lot of money. I mean, Steve Schwartzman came out publicly last year and said they were going to put 100 billion into Europe in the next 10 years, I think, or 500 billion into Europe. The numbers are pretty astonishing, and other big firms are allocating as well. So those flows can drive returns for a long time.
Right. And the thing with the staples is you always want to track the rate of change in the staples, because if say recession probability is really, really, really low, but if there's a sharp rate of change, capital flowing into the staples, that means that recession probabilities may be rising a little bit because staples are defensive. In other words, they outperform in tough economic times. Next one. So Mark, this chart, vol, one of the things we track is holiday shortened weeks. And I find it interesting that, because typically if you buy vol around, like into and around holiday shortened weeks, it's typically a good time to buy. So think of like the 4th of July week. There's a lot of people not in the office. A lot of the vol sellers will push vol down when they know there's not a lot of people around. But what's interesting about this week, we're into a holiday shortened week, but because Trump, it's very similar to 2021. I'm sorry, 2025 in that first quarter, 2025 last year, where Trump, it's almost like he's trying to knock the market down. Like tape bomb after tape bomb, going after credit card companies, going after defense contractors, CAOs, you're getting paid too much. Obviously Venezuela, Iran. And when I sat down in our book number one last week, number one, How to Listen to Market Speak, we sat down with David Tepper in the book. And one of the things Tepper talked to me about when it comes to buying volatility, he said, Larry, the market can take 1, 2, or 3, maybe 4 things at the same time. But once it goes to 4, 5, or 6, where these uncertainties that are big headlines, and Trump is a master at creating these, right? Once you go up there, you get, it's a good time to buy vol. That's his point. And then I find it interesting that typically where vol should be sold this week, there should be a lot of pressure on vol. I find it interesting that vol's actually had a good 10-day period.
Yeah, no, you're right. It's been it seems like every day or a couple times a day there's new news that you think would send the market lower.
Right.
It hasn't happened, but maybe you're starting to see people get more concerned.
But vol is but what's interesting, vol the VIX is actually up quite a bit,
right.
since over the last week or two. And then a lot of clients are mentioning this, that gold silver ratio. So we in the book we talked about the gold silver ratio, and we recommended, we had a high conviction trade alert in the first quarter of last year on silver. And anybody that wants to be on our trade alerts, it's info@thebeartrapsupport.com for clients. But remarkable move here in silver versus gold. The ratio has gone from 90-ish to 50. In a real bull market, historically, you can get down to the 30s. But the dollar, it's interesting that the dollar hasn't kept pace with the latest move. And some people think this is silver's foreshadowing a move lower in the dollar. But, net, the dollars had a really bad year last year. You might get a counter trend rally for a little bit, but the trend on currency debasement globally is pretty broad, right? From Japan, UK, US, and I think that's helping the dollar a little bit. Next one. If you have any thoughts on the dollar here, Mark?
No, we are, I'd say, negative on the dollar on the margin. And we think that, what we're hearing from investors in the U.S. is they like to get a little bit of diversification outside the U.S. And the marginal dollar from foreign investors coming in the U.S. is a little bit less. They may be putting money in the U.S., but at a slower pace. So we think the dollar, dollar's had quite a run. I mean, since we founded our firm, 6 years ago, we've seen the yen go from, 100 to 158. We think the dollar should be weaker probably over time, and that would be a tailwind for international investing in international
Right.
stocks. Well,
Right, exactly. And then the 200-day moving average has been a real sell point for oil the last year. You can see that that pink line, we failed there. But when you think about Venezuela, you think about Schlumberger. So Venezuela production's gone from 3 million barrels a day down to 1 million barrel a day, 1 million. And you can get the next, if you get some engineers in there, you're going to might be able to get another 400,000 barrels a day. But to get back to 3 million barrels a day, which was the old high, it's going to be $100 billion, $100 billion of investments. And a lot of that money is going to go to the Schlumbergers of the world. So we've been long Schlumberger for the last year, buying it, Weatherford, buying the oil service names on the last 2 quarters. We've sold some gold miners, moving into some of the oil names. But I find it interesting here that you've got this big move up in energy. You've got everything going on in Iran, and the sentiment, the bearish sentiment, the positioning has been so viciously bear. In other words, everyone's short. And when that happens, headline risk can really create those vicious counter trend rallies where short covering. And that's why we've kind of failed, because it's really that move looks great, but it was a lot of short covering. It's not a real move yet. So we're waiting for the big move higher, but we're under a lot of pressure in an election year with Trump, putting all that pressure, all that political pressure that he has with the Saudis. He really wants oil prices lower heading into the election.
And we've liked oilfield services for a while, and we're down in cap from Schlumberger. I used to cover Schlumberger when I was at First Eagle, but we're down in cap a lot from there today. But there's a lot of smaller and kind of mid cap companies that we think have done really well, because we agree with you that the CapEx still needs to get spent, and they're going to get paid first. So it's a little bit less direction, view on direction of oil prices, although say maybe there's a bias
Right.
to the upside. But we like oilfield services quite a bit.
Right. And one thing we hate here is the financials. I mean, this is absolutely 2007. Okay. Think of how insane the financials were in 2007, right? Goldman was like 2.1 times book, right? 2007. That's literally when the financials had the highest percentage of S&P 500 composition, I think almost ever, right? That's how hot the sector was. Everyone was long the financials. And Goldman's price to book, a lot of earnings came out this week in the financial side, and guess what? The bar is so high. When you're trading at 2.4 times book, greater than 2007 levels, it's just pure idiocy to own the financials here, not to mention the problems in private credit. There's a lot of smoking bombs in the credit side that are starting to kind of come to the surface. So we've been we've been really bearish on financials here the last couple of months, and we're even more bearish now.
And just
And
my observation there is we saw a lot of speculation measures we look at for speculation. We saw were the highest ever through like from mid-April through the end of the year last year. And financials did really well, even in the small cap space. And we that's an area we tend not to be invested in because we don't think they have competitive advantage. But you're right. I mean, Goldman's expensive. I mean, a lot of the other big major money center banks are trading all-time high valuations as well. And it's
Mark,
gone all the way down to those small caps too.
And Mark, let me ask you a question. So if you're bearish to financials, you're kind of bearish value. So I'm sure people are saying that right now in their head, like Larry McDonald likes value, but he doesn't like financial. But that's why that global value, right? Because a lot of the U.S. J.P. Morgan is trading at 2.6 times book, 2.6. The long-term average is like 1.4 times book. So that's another kind of ingredient that really kind of makes me think about small cap value, right? Because that's U.S. financials are making value in the U.S. more expensive. No,
there's always contraindicators. A couple of years ago, somebody came to us and said, you guys are value, but you don't own all the value stocks, and we don't own a lot of stuff that trades at half a book. We don't own a lot of financials. Again, because most of financials don't have any real competitive advantage, right? If you want to borrow money, and you might want to borrow money from J.P. Morgan, but if somebody else will lend you the same amount of money for half the rate, they're lending you a commodity at the end of the day. It's not. I mean, they've got a lot better businesses beyond lending, but you get the idea, right? There's not necessarily a lot of competitive advantage there. But they were giving us grief. We didn't own financials, and that was like 2 weeks before SVB blew up, Silicon Valley Bank, and then they came back up 3 months later and said, "You're right." I'm like, well, yeah, we don't own this stuff because we don't understand what's in it. We think the risk is very asymmetric, so we don't want that kind of downside risk where it's great until it's not, and then you've got a lot of downside.
Right. And I love this chart. The metals are almost outperforming the Qs by almost 500% since the first quarter of 2020. Almost 500%. The top 5 stocks in the XME metals ETF are only worth, I think, maybe 100, maybe 300 billion, maybe $200 billion, right? And the top 5 stocks in the Qs are worth 15 trillion-ish or something like that. So like I said, it just doesn't take much capital to move out of the crowded trades into the rest of the world, into value, into global value, into portfolio. Like I'm sure Mark, you said this last 3-4 months you've had the highest increase of investors coming into your fund in terms of asking for proposals.
Yes. Yeah, we've seen more interest in the last 3 months. We've got more RFPs outstanding for more today than we've seen in the last 5 years. I mean, it's definitely, there's a lot of interest coming in the space. And you're right. I mean, the XME metals is small. The S&P energy component of the S&P is probably, probably peaked in 1980 or 81, 82. And it's, down to like 4% of the S&P, right? They're tiny. I mean, even Exxon compared to, the Mag 7 is small now, right?
Yeah. Yeah, I love how Exxon's outperforming CRM by something like 200% since they kicked Exxon out of the Dow Jones Industrial Average. It's absolutely hilarious, right?
But it's a great contraindicator, right? It's based on past performance, not what happens in the future.
And so one thing people are talking about today, we're going to wrap it up here pretty soon, but Hassett made some comments today, and the big joke is Trump likes Warsh because he's a little bit more handsome than Hassett. But that's kind of the conversation piece of the week. But it is interesting that Warsh is so hawkish, especially on the balance sheet side. Hassett's a lot more controllable, and it's interesting that you got this move down in Hassett. And I think the market was really, I think equities liked Hassett because that's a more dovish Fed governor, but whereas you really don't know with Warsh, and Warsh's relationship with Druckenmiller and Bissent is very close, right? Very close. So that might get people worried about, okay, how close is Treasury, and how close is Treasury to the Fed? But interesting move here, down with Hassett relative to his comments today and Trump's comments, and then Waller. Then Warsh coming up. But I think that's about it. We'll wrap it up. How to listen markets speak. We got a great cover of the book here, right there. #1 on Amazon last week. I'm really, really proud. to have a book out almost 2 years and have it back up at #1 in money and finance. Thank you so much to everyone. Mark, thank you. Happy New Year, my friend. I think we can still say Happy New Year to the end of January, right?
Sure. Thank you very much, Larry.
Okay, all the best.
Take care.
Thanks.
Bye.
Okay.
Thank you, Mark. Thank you, Larry, for such great insights. So, as you guys heard, we have a Bloomberg live chat, and let me tell you a little bit about that. Since 2010, Larry and the team have hosted this chat. We have more than 600 investors all around the world in more than 23 countries. We have small contributors. We have people that, talk a lot. We have people that are just kind of viewers. And if you're interested in reaching out to there, just text us as info@thebirdshopsreport.com. Also, we have a Discord chat. It's pretty similar to the Bloomberg, and it's really good to have on your phone, on your iPad, right out of a meeting. If you just got off the plane, it's perfect for you. So reach out to info@thebirdshopsreport.com. Thank you again for joining us, and we'll see you next week.